There will never be a better day, baby, for me and you to live and learn. There will never be a better day, darling, for me and you.
Hey everyone, good afternoon. Curtis Ray here. Time for a new Q&A session. So as I did my webinar yesterday, I said I'm going to do a live question and answer right now. So if you want to ask me a question, feel free to start right now. We're going to go on. I had some questions yesterday and a few others that came in last night that I'm going to answer out of the gate. And then as you guys get going, you can ask questions and I will answer them. So to get started, I always like to ask you guys to follow me on YouTube, Facebook, LinkedIn, Instagram, TikTok, and Twitter. That is how you can find me, at Curtis Ray, and I am Curtis Ray, and I appreciate it. We're always putting out new videos. We're always putting out new content, all things compounding. As you guys know, I'm the compound guy. Compound interest is everything. It's the eighth wonder of the world, most powerful force in the universe. So anything you want to know about compound interest, you can find it on my social media platforms. So the first thing everyone always asks me is, what is compound interest? How does it actually work? So let's look at compound interest here. Here are two different lines, the gold line and the black line. Compound interest is money making money for you. And then that money also makes money for you. So you have multiple monies making money, and then that money also makes more money and more money and more money. And ultimately you end up with hundreds and thousands of different little employees, I call them, the money employees that are making money for you. And so what happens is the black line right there is your money, how much money you invest and how much money you're putting in. And then the gold line is all the additional money that you make inside of compound interest. And so as you can see here, I'm going to draw a little line. This is the amount of money that you make. All this money here is compound interest. So as you can see, sorry, my handwriting is terrible. As you can see, compound interest ends up being way more money than even the money you put in. Always be compounding is a philosophy. It's a lifestyle. It's a commitment that you make, that you want your money making money than money making money. So Xander, raise your hand anytime there is a question and we're good to go. So the next question is, what is MPI? MPI is a financial plan that encompasses 10 things all simultaneously. And those 10 things are, as you can see here, the first thing is life insurance. It is a life insurance plan. Why is it a life insurance plan? Because inside a life insurance is the only place you can possibly get the guaranteed never to lose feature. Inside life insurance, we cannot lose. It has a no loss feature inside of the stock market. And so we like that inside of our financial plans. The second thing, real quick, there's a camera right here and it's really delayed and can you look at it? What? But can you take it off? Oh, okay. Sorry. Okay, you have a question?
I do.
I'll go back to this after you ask the question.
T. Flynn from TikTok asked, what annual interest rate are you getting?
T. Flynn from TikTok. What is my annual interest rate inside of MPI? MPI is built on compound interest. And the fascinating thing and why MPI outproduces all other compound accounts is because compound interest is gradually getting faster and faster and faster as time goes on. I'm going to go back to this thing right here. This speed right here. Compound interest starts off kind of slow right here. And then it gets faster and faster and faster. So MPI starts off somewhere between 6 and 7%. And as time goes on, it matures into 8, 9, 10, 11, 12, 13, 14, 15%. And so we are built on not the rate of return, because that's really important. But what's more important is the rate of compounding and how fast we can increase compounding. And MPI is the only system built this way. It is one of a kind because we focus on the most important thing, is that's how you accelerate your compound interest. And so, yeah, we start off somewhere around 6 to 7%, not sexy, not flashy, not anything. But as time goes on, it gets faster and faster, which makes it 8, 9, 10, 11, 12. And so it just keeps getting faster and faster and faster until you absolutely produce the best future. So when we build MPI, it is building for your best future, not today. We don't care about today. We care about how we gradually get faster. Second question.
Axel from Instagram asked, can you take your money out whenever you want?
Axel from Instagram, can we take it out anytime we want? I'm going to go real quick to a graphic I have. There it is. Accessibility. MPI, you can access your cash value at any point in time. We do have a thing called a surrender charge, which is your first year. So if you put in, let's just say $5,000 this year, that money would not be accessible. That's kind of like get in the game, get in your cover charge to get in the door. The money you put in after your first year and all the growth, which is called your cash value, is 100% accessible at any moment in time. About 95%. There's little things that they require, like the interest payments on accessing your money and stuff like that. But so MPI, unlike a 401k, does not have the 59.5 age restriction. You have no retirement restriction, no access penalty, freedom to use your money as you see fit, whenever you see fit, except for the first year. That first year contribution is not liquid. And so that is the one caveat in MPI, is they do hold a little bit of money as kind of as escrow so that you don't cancel, but all your money you put in year 2, 3, 4, 5, 10, 20, all the way forever, plus all your growth is accessible with no penalty. Cool. Oh, next question.
T. Flynn again from TikTok. How is it different than a Roth IRA at 10% index?
Okay, that's a fun one. So a Roth IRA doesn't do 10% index. That's unfortunately is a flaw and a misconception, because here is what has happened in the indexed fund over the last 30 years. And you see here, it is 9.8%. I'm going to circle this real quick. You see that right there? 9.8%. That is what it has averaged over the last 30 years. But if you take this right here and you run this down and you only have the last 20 years, it has averaged 6.3%. So most everyone on this call, everyone that is my age or younger, I was 18 years old in the year 2000. That is only 6.03% growth inside the index fund if you did a Roth IRA inside the index fund. And so although the 90s were awesome and the 80s were awesome, and a lot of people tell you that it's going to make you a bunch of money here and there and you're going to get 10, 12%, that unfortunately is not how it actually works in the current environment. The last 20 years, we've made -9, -11, -22, 28, 10, 4, 15, 5, -37, and so on and so forth. And so you ultimately end up with only 6.03% in the last 20 years. So MPI averages about the same thing. We're about the same as an index fund. However, because we're built on secure compound interest, not ups and downs and home runs and strikeouts, we're built on secure compound interest. Our rate of return through a bunch of features we have can increase it to 7, 8, 9, 10, 11, 12, 13, 14, 15 as time goes on. Another thing I want to explain real quick why this number exists. Because if you just took this number all the way down to this number, it's around 7.5%. So why, if we've averaged 7.5%, we're actually only getting 6.03%? And that is a thing that a lot of people don't realize inside of finance, that money lost has more influence than money gained. What does that mean? If you had $10,000 inside your Roth IRA and you lost 50%, you would have $5,000, right? If you gained 50% back 1 second later, how much money would you have? Most people say $10,000. You lost 50%, you gained 50%, you have a 0% average, you got your $10,000 back. That's not how money works. $10,000 losing 50%, plus 50% back, you'd only have $7,500. A 50% loss would require a 100% gain just to break even. So although you averaged 7.5%, your actual rate of return, what you actually made on your money, was only 6.03. So what's different between MPI and a Roth IRA? We don't lose. So we never take steps backwards, and that allows us to continuously compound. I'm going to go back to this slide right here, is we want this right here. We want this always going up, gradually going up faster and faster versus this. This is the stock market, and that's the problem, is it never actually compounds for you. I'm gonna do one of these features and I'll get to the next question. The next thing inside of MPI, we had permanent insurance. It is a life insurance plan, but to lower our expenses inside of MPI, we buy the absolute lowest amount of life insurance required by law, cutting our expenses up to 95% less. Off most traditional plans, it's about 70% less, but up to 95% less expenses than some of these really, really crappy cash value life insurance plans. Most cash value life insurance plans are absolutely terrible. So if you have a cash value life insurance plan, we should look at it. Also, we have living benefits, meaning if you ever got sick from cancer, heart attack, stroke, some very severe health concerns, you can advance on this life insurance to pay for medical expenses. So it's a really cool feature called living benefits that you can use your life insurance even while you're living to pay for medical expenses. Next question.
So from Instagram, is MPI more economical, responsible, or have a better money return than real estate?
That's an easy question. Real estate actually doesn't grow very well. You can look this up, that the real estate market has grown by about 4.2% over the last 20 to 30 years. So real estate's not designed to compound well. But what you can do inside of real estate that's really cool is you can leverage. You can borrow money from the bank to go buy two houses that are both appreciating at 4.2%. And then you pay some interest, but it accelerates your rate of return. So real estate has some really cool features. Growing is not one of them. They don't grow very well. But because you can leverage, you can manually build little growth. And if you get a bunch of little growth, it turns into fairly good growth. So if you want to have a really complicated job and you want to put a lot of effort into it, you can grow a real estate empire. 10X they call it, right? The 10X convention is about real estate typically, but it takes a ton of work. Real estate by itself doesn't compound very well, and why MPI by itself can out-compound real estate leverage. So MPI by itself, through its compounding features, with no effort on your part besides put money into it, can produce way more wealth than real estate leverage and buying 10 rentals and doing all that crazy stuff that goes on out there. So compound interest is the most powerful force in the universe. Real estate is a leverage feature, not a compound feature. Next question.
JC from YouTube, can you discuss the self-assessment PDF tool and where can I find it?
JC from YouTube, about my PDF. So I'm gonna click out real quick out of my screen, and I'm gonna open up something. You can see it? Does it still work? Okay. So we just developed this. This is super cool. It's not available yet. It's going to be available in the next 1 to hopefully 7 to 10 days. But what this is a MPI plan. You can build your own plan. We obviously want to build it for you so you know how to do it, but I'm going to go through it real quick so you can see it. This is going to explain what compound interest is. It's going to explain all the cool things. It goes through, here's compound interest, eighth wonder of the world. It's continual growth. It shows this chart right here on how it grows. It talks about the triple advantage, how MPI is the only system that has the guaranteed protections of life insurance, the growth of the stock market, and the leverageability of what real estate does. We don't use real estate, but we use the same tools, how to leverage money, lines of credit, how we optimize and accelerate your compound interest, all inside the same system. One feature is good, 2 is great, 3 is optimal and produces the best results. And so then you end up going here and we talk about, we build your plan. So if you meet up with us on a one-on-one, we'll understand your assets breakdown, how much net worth you have, how you build a plan, put in your information, then you build your plan right there. And then ultimately it's going to spit out a number. How much money you put in, how much leverage you have, how much cash value you have, what your projected tax-free retirement income is going to be, your tax-free retirement income is going to be, and then congratulations, you're on your way, man. That is awesome. And so this is going to be available hopefully in the next 7 to 10 days by appointment only, and then hopefully in the next month It will be on our website that you can go on there and build your own plan. No obligation, no cost. You don't need to fear that we're going to try to sell you. We're trying to provide you information and education. If you don't want it, your loss, not mine. A lot of people are taking advantage of compound interest. We want to give you every tool, every possible opportunity to produce compound interest in your life. And so this will be available in the next 7 to 10 days. Meet up with us. Do we have a little graphic on how you set up a one-on-one appointment? So there's a bunch of people in my office, Megan, Ian, Rob, Chris, me, that do one-on-one appointments with people. And we can use this, build your plan, PDF, save it, and then email it to you so it can become your Bible when it comes to retirement. And then this plan also goes through all these 10 features and breaks them down one by one. Talks about the life insurance, talks about the living benefits, talks about lowest expenses, how we cut out almost all the expenses out of a traditional cash value life insurance plan, the tax advantages, how we're a post-tax system, 100% tax-free retirement income, how the legal protections, no age distribution, how we have accessibility before 59.5, no access penalty, how we guarantee our security, we never lose inside the market, how we do that, how we grow our money, the secure compound growth, and then ultimately how we leverage the MPI match program, where we can take a match line of credit to accelerate our compounding. And when you do that, you end up producing up to 4 times more retirement over any 401k IRA out there. And so that's really, really cool. This is going to be available to you guys within the next 30 days, but you can set up an appointment now and one of my certified agents can build it for you. No obligation, no cost to you. We can build it for you and you take it home. So did we ever do that one-on-one? It's not there yet. I haven't seen it pop up yet where it says one-on-one consultation. Okay. There it is right there. Okay. Go to calendly.com/SunCor Financial and you can do a one-on-one consultation free of charge. We just want to provide this great information for you. Next question.
Maula from Instagram asked how you can start a company after a huge crisis like this. He actually wants to be on the live with us.
Oh, he wants to start a company.
He wants to, but he actually wanted to see you.
Hey, what's up, brother? Where's he at?
I'll put him on.
Okay, I don't know how that works, but
we're about to do it right now.
Oh. What's up, brother? How you doing? No problem at all. Thank you for coming on. But you just asked a question, so I'm going to answer that question. The question is, how do you start a company in a down market, or if you have no money, right? Something like that. There are so many things. If you can bring value to the world, it doesn't take a lot of money to bring value to the world. For example, to start my financial planning business in the beginning, took me about $600. 4 years ago, I was able to start my financial investing firm, or my financial planning firm, on as little as $600. I studied it, I passed my license to start my course, and then I just started pounding the pavement. Facebook Live videos, providing value. So whatever your passion is, find out what your passion is and go do it. But you've got to be willing to put in the hard work, because here's a little thing. I started talking about money about 4 years ago, and no one listened to me for the first 4 to 6 months. They're like, who is this guy? He's a granite countertop guy. Why is he talking money to me? But I stayed disciplined, and I posted and posted and posted. And then one day, one person reached out, 2 people, 5 people. And now thousands of people reach out to me every single week wanting to know how money works, but I was willing to do the hard work. So right now, find something that brings value and then go do it every day. But you don't need to have a lot of money. You just need to have the desire to go out there, work hard, work your 12, 14 hours a day and make it happen. But you got to have a niche. Niche markets are where it's at, where what is your passion? Find it and go find someone who wants to listen to you. Oh, you want to like photography and stuff. Yeah, so that's the same thing. If you're a photographer and you already have your camera set up, start posting your photography nonstop and get people to like it. It doesn't cost any money to do that. So you can do that pretty easily and go on every platform. Instagram, TikTok. I mean, do live videos and saying, hey, this is what the value I bring. Here's my cool pictures. Here's my sceneries, whatever type of photography you're in. That's really, really cool. I mean, people love that stuff. And then you can start booking out. Maybe someone wants to be in the photography and they pay you to then, come out and photograph them up on a mountainside or, with their kids and stuff like that. But that won't cost you anything if you already have your camera. So just get your name out there and make that happen. So thanks for coming on, man. And nope, I appreciate it. Awesome. Thank you. Cool. Next question.
Next question is Chad on YouTube. It's going to MPI versus IUL.
Okay, MPI versus IUL. Let me see if I have that one. I think I have that one somewhere. Okay, there it is. Graphic up. MPI, is it just an IUL? Indexed Universal Life is pretty cool, but it's also has some tremendous flaws to it. Indexed Universal Life, the insurance cost gets really high in the later years and it eats up a lot of your cash value. It grows at around 6 to 7%. It has a lot of really cool features in it. It just is limited. So what MPI did is it stripped out all the great features inside of an IUL, which is the security, the liquidity, the life insurance part where you can lower your life insurance a lot. And then we enhanced it through the leverage. So what you can see here is an IUL versus an MPI. As you can see in the beginning, they're the same. We both start off in the same place. We buy a life insurance plan, but we start to leverage our life insurance plan. We start using the MPI exclusive and proprietary match program. And through that match program, 30 years later, there's up to a $400,000 difference. And then as you start getting a retirement income off of this thing, an IUL can produce around $70,000 of tax-free retirement income if you put in $10,000 a year every year for 30 years, where MPI can produce up to $193,000. So 3 times more retirement income, a lot more death benefit, a lot more cash value, same security features. So what MPI is an IUL on steroids. It basically is an IUL 2.0, iPhone 11, not an iPhone 1. So an IUL is equivalent to an iPhone 1. MPI is an iPhone 11. Now you can imagine the difference. If you had an iPhone 1 versus the 11, they are dramatically different. We just use every feature available inside of an IUL, and we fixed it so it works optimal and eliminate all the problems of it. And now we can produce up to 3 times more income. Yep.
Greg Uphold from Facebook. So if you put $20,000 in the first year, where does that money go?
Okay, so Greg from Facebook said if you put in $20,000 a year, where does that money go? The money is deposited directly into the life insurance company's bank account. So one thing a lot of people don't realize with life insurance plans, why they're so safe is because your money actually goes to the life insurance company, who the life insurance has made money for 100 straight years. Life insurance companies made money even in the Great Depression, 2008, .com. They don't ever lose money ever. They are awesome. And that's why they're considered the most secure asset in the whole world. They're equal in security and volatility on the risk pyramid, equal to an FDIC insured bank account. So your money goes into the life insurance company's bank account. Their bank account is invested in various secure investments such as AAA corporate bonds, long-term mortgage notes, things that have long-term security, of long-term history of minimal volatility. And so your money goes in their bank account. That bank account now makes you money, and then we do a bunch of fun stuff with that money, as you probably know from my other presentations, that all your money goes into their bank account, and it is 100% contractually secure that it will never lose money.
All right. Victor with Instagram asked, what is the match? Is the company matching interest?
The match, the MPI match program is the coolest program there is. After the second year, you have to be in the system for 2 years. You got to qualify for the match, and that is time. You got to give it 2 years, and why we want to start this plan as soon as possible to get this thing rolling. So what the insurance company does is after 2 years, the amount of cash value that you have in your plan, they'll give you a dollar for dollar match to that you can then go use however you want. It's basically a loan against your cash value. So let's traditionally say that you had I'm gonna clean this up. Let's just say you had $10,000 of cash value inside your account. The insurance company will give you up to a $10,000 loan. This $10,000 is making you around 7% interest. So you're going to make around $700 inside this, on average, inside of this MPI system off of your money. After the second year, they'll give you a dollar for dollar match. And so this $10,000, you can then go spend it on anything you want. They're matching you. They're basically saying you can have this loan for whatever reasons you want, and it's going to cost you 4%. So we're going to lend you money at 4%. So even if you go spend it, you're still making 3% on your money because your money's making $7 or $700. They gave you a $10,000 loan, which is costing you $400. So even after you spend your money, you're making $300 on average. That's pretty cool. But that didn't help your compounding. So what we do is we then go and we take this $10,000 and we put it as a match program back into the system. So this $10,000 has the potential to make you 7%. Just like your money. Your money's making 7. We're allowed to put this money back into the system making 7% also. Still costing you 4%. So now instead of a negative 400, we've now just increased, let me erase some of this, because we're making 7% on our money and it's costing us 4%, we now made a positive 3% spread even on borrowed money. That is the match program. They allow you a line of credit against your cash value. We take that line of credit, we put it right back into the bank account, into the compound account, making us on average 7%. Cost us 4, we make an additional 3. Now that gets added, this $300 gets added to our $700, so we just accelerated the compound interest. That's how we take our rate of return from 7 to 8 to 9 to 10 to 11 to 12 to 13 to 14 to 15. A normal IUL can't do that. And so through this match program, that is how we get up to 15% rate of return.
All right. MP Word from TikTok asks, is the 7% average based on the S&P 500?
Okay, so what was his name?
MP Word.
MP Word from TikTok. Is the 7% rate of return according to the S&P 500? Let me see if I have that graphic here somewhere. I may or may not have it, so let me find. Oh, crap. Went the wrong direction. Give me 1 second. We are live, so sometimes I got to figure this out. Okay, so we are in a system that cannot lose. It has a thing called a 0% floor, and I do not see that graphic here. Okay, we can kind of see it right here. If you look here, if you want to blow this up, Manny, just on the right side, the MPI returns. So we're in a system that has a 0% floor, meaning we never lose. But we have a cap of around 11%. And it's according to the S&P 500, meaning if the market did, let's just see right here. See how the market did 30%? Oh, I circled the wrong one. 30%, we made 11 because that's our cap. If the market did negative 37%, we did 0. That means our floor was 0. When the market did positive 32, we made 11. So we are slow, steady, and secure. We only get singles and doubles, but singles and doubles provide the best compound results. Home run and strikeouts provide the best emotional satisfaction. They're real exciting. We go for the home run, but we also strike out often. And so the MPI is built in the S&P 500 call option, which is off the index, with a floor of 0 and a max of 11. And when those two things combine, 0, 11, 4, 7, 0, 11, 11, 11, 0, 11, and come out and so forth, we'll average right at 7%. Over the last 30 years, 15 years, it's always right around 7%. JC
from YouTube. 15-year or 30-year mortgage? Or should I look for an option in the middle, let's say 20-year mortgage?
Always as long as possible. So I do have a graphic for that. I know that much. Okay. So here's a little thing I'm going to tell you guys, and this might blow your mind. You've been taught that your mortgage is compound interest. It is not. It is amortized interest, which is a simple interest, meaning it is fixed, it is not changing. Compound interest would be if your principal value got bigger every year, when the interest gets added to your principal value, so you're paying more interest the second year and the third year and the fourth year. That is not inside of mortgages. It's not even inside of credit cards. It's not inside of almost any debt that requires a minimum payment and that has a path to payoff. So your mortgage is not compound interest, and anyone who tells you that, unfortunately, has not studied how compound interest works. So here's an example of a 15-year mortgage versus a 30-year mortgage. I'm going to show you two examples that if you got a $300,000 mortgage, right? So you got a $300,000 mortgage. You want to pay it off in 15 years. That would cost you $2,182. And in 15 years, your mortgage is $0. Congratulations, you have a house paid off. Equity is dead. It does nothing for you. It is not a benefit to you to have your house paid off. You just gave your money to the bank, and what are they going to do with your money? Go compound it. So you want to give your money as slow as possible to them. Then if you took the $2,182 left over and you compounded it for 15 years, you'll end up with right under $1 million inside your account. However, if you got a 15-year or a 30-year mortgage and paid the minimums on it, which would be $1,432, and you took the other $750 and started compounding immediately, but gave your compounding more time, 30 years, you would have up to $1.7 million, $800,000 of more wealth for you. Both scenarios, your house is paid off. Both scenarios, the exact same amount of money came out of your pocket, $2,182 a month. But one scenario end up with over $800,000 of more money, and as time plays on, ends up with up to $2,000 or up to $2 million more money in your account. And as this thing keeps playing out, compound interest will always outperform simple interest. So you never want to pay off simple interest faster than you have to. And you always want to get money compounding as fast as possible. This whole saying out there that people say, you want to pay off your debt as fast as possible so you have more money to compound later, is completely and utterly backwards. Compound interest does not work that way. Compound interest is time, and more time. If you can give any amount of money a lot of time, it will produce amazing results for you. So yes, get a 30-year mortgage, pay the lowest amount possible, but you have to be disciplined to take every dollar possible and start compounding it. If you can take the difference in compounding it, you will inevitably end up with millions and millions and millions of dollars. It will happen every single time you focus on compound interest.
All right. Ollie from Instagram. In the match program, would you ever find yourself in a scenario where you would have asked to pay the $10,000 back?
Never. And why is that? And so I'm going to go back to, so the question was, Ollie from Instagram, in the match program, would you ever have to be required to pay it back? Remember, let me go to one of these things where I can write here. Okay, remember, so when you have $10,000 inside your plan and they'll offer you a match, when you put it back into the MPI system, inside of their bank account, it is now what I call self-collateralized, meaning this money is inside the life insurance bank account, making you around 7% interest on average. They're going to keep 4 of it, and you get to keep the compound interest. This money was never your money. Leveraged money is never your money to keep. You just get to keep the benefit of leveraged money. And that benefit is up to 3% additional compound interest. And so they don't expect you to pay it back. The life insurance companies don't want it back. They love the 4% guaranteed interest that they're going to get. And then when you pass away, they actually take the money back. They have a thing on the money called a lien just like on a house, where they own that money. That money is not yours. Although there's $20,000 inside your compound account, 10 of it is yours, 10 of it is theirs. And so you're not required to pay it back because it was never a liability to you. It was never off of your cash value. Okay.
So I have $4,000. Should I buy a gaming PC?
You have $4,000. Should you buy a gaming PC? Well, I do know a lot of people who make money gaming. So if you plan on using gaming and you're good enough to go make money off of it, that might not be a bad investment. It might be something you go do. And then when you start making money off gaming, then you should go start a compound account. Make money, compound money. Make money, compounding. But if you're not making any money, you can't compound any money. So I believe in starting something that makes you money. So if you can take that $4,000, go find something you can do to make money so you can start compounding money. Or take that $4,000 and start a compound account and go get an 8-to-5 job. And every dollar you make on that that's available, keep compounding, and you're going to end up with millions of dollars anyway. So either way, compound interest is your path. Here's a little graphic I want to show you guys about compound interest and how cool it is if you were to take $5,000 right now, you said 4, this just happens to say 5. If you were to take $5,000 right now and go put it away, in 30 years, it'd be worth $85,000, give or take. That means $5,000 produced over $80,000 of money for you. So if you put away $5,000 every year and you kept putting away more and more money, you keep having these more and more buckets making you money, and you end up with millions of dollars. So if that $4,000 that you just talked about can make you money, that's a good investment. If it's risky, don't do it. If you just want to build your future right now, start a compound account.
MP Word from TikTok. How are your clients doing during COVID-19?
MP Word from TikTok. How are my clients doing during COVID? They are doing awesome. So we started this 6 years ago. None of my clients have lost a single dollar from COVID because we're in a system that has a 0% floor. What happens inside the MPI system is we have a 2-lever system, meaning when the market is crashing, we have a guaranteed security lever. So we pull this security lever whenever the market's crashing, basically protects all our money that we can never lose. And right now, security lever is pulled because it's so volatile and a bunch of crazy things are happening. But my clients can sleep with confidence, sleep with security, knowing that their money is protected. The moment the market starts going back up, which it's been going back up, so we're allowing the growth to be part of our play again, we have a growth lever. We pull the growth lever and we rock and roll with growth until we need a security lever. The security lever happens automatically. It's not something you have to like, oh, the market's crashing, got to pull it now. It happens automatically. Your highest point inside of MPI, meaning your highest account value, will be contractually guaranteed to be your lowest account value from market risk. You do not have market risk of losing account value inside of MPI. And so right now I have thousands of clients and people looking into MPI and all that fun stuff. And why my business is exploding right now and why I do these live videos all the time and I have hundreds of clients every week reaching out to us and wanting to talk to us is because we're one of the only systems that can conservatively protect your money and aggressively grow your money simultaneously. And that is a really cool feature, and why you guys are listening to me right now is because we have something really cool to offer you, and it's backed and provided by a multi-billion-dollar life insurance company that has your back inside these timeframes to guarantee that you do not lose inside of market risk.
Tina T on Twitter. I have a Roth IRA and there's a limit. Is there a limit to put into MPI every year?
Tina from Twitter. Awesome. I always joke that MPI is a Roth IRA on steroids. It's the rich person's Roth. We also are a post-tax system, meaning we put in tax, post-tax money. I actually have a graphic for that. I have a graphic for everything. If you guys haven't read my book yet, The Lost Science of Compound Interest, I have 85 different graphics in this book, and it breaks down every single feature inside of MPI. But here is the advantages, the tax advantages of MPI. We are like a Roth IRA, where we put in post-tax money, but our limits are 7 figures for some people, 6 to 7 figures for everyone. So you can put in a tremendous amount of money, typically equal to your full salary. So if you make 100 grand a year, you typically can put in somewhere around 100 grand a year, 50 grand a year, $1 million a year. We don't have the traditional limits of a Roth IRA, and why people like the MPI system more than a Roth IRA is because you save $6,000 a year for 40 straight years, you only end up with like $600,000. You're not even rich even though you did it for 40 straight years nonstop. Inside of MPI, you want to retire in 10 years and you want to stuff a bunch of money away, you have the liberty to do that. We're all about freedom. Having the freedom to use your money, having the freedom to put in as much money into a compound account as possible, having the money to do it how you see fit without all the stupid red tape of traditional financial 401ks and Roth IRAs and IRAs that have restrictions and penalties and tax you later and all the other crap that goes along with it.
CDG from YouTube. Are loan rates fixed or variable? If variable, how often and how can they change by what magnitude?
CD from YouTube. So we have a loan. Let me see if I have that thing. I don't know if I have that. Okay, so our loan rate right now is 4%. And our maximum growth is around 11%. So I'm going to put two little things here to explain something real quick to you. Cap, loan. And with an 11% cap, we can average around 7% per year. So we have the potential to have up to a 3% spread on leveraged money. Our maximum capped rate is 6%. We have a contractual guarantee that we can never go above 6%, which is nice because we still create a spread, even at worst case scenario, and they go all the way up to 6%. But something that's pretty cool that happens inside of loan rates, if you remember, when I said the insurance company invest your money into AAA corporate, they put your money inside of their bank account that gets AAA corporate bonds and long-term mortgage notes. Typically, historically, when this loan rate goes up, our bond rates and our mortgage rates and how much money our general account or our insurance can make us also goes up. So traditionally, this cap can also go up to 13 to 15%, which raises our average up to 8% plus. So we still have this spread that we can achieve inside of the loan and still get 2 to 3% spread. We've run it, and actually a 13 to 15% cap with a 6% loan is better than an 11% cap with a 4% loan. That's pretty complicated, but what I like to finish with that on is even at a 6% cap, 6% loan and an 11% cap, we can still create a spread and still create a leverage. The match program still produces you benefit, and we can end up enhancing and accelerating your compound interest.
JC from YouTube, what is the best way to pay off a credit card debt?
JC from YouTube, what is the best way to pay off a credit card debt? We look at that. I recommend doing a one-on-one consultation to look at your credit card debt, what the interest rate is, what your minimums are, what is your disposable income, and build you a compound account looking to pay off that credit card. See, there's a problem with the theory of pay off credit card. Let's just say you had a $10,000 in credit card debt. And you went and you paid off, or let's just say you had $10,000 in credit card debt. And I always joke, let's say great grandma kicked the bucket and left you $10,000 inheritance. And you went in and you did what Dave Ramsey told you to do and all the other people tell you to do. And you paid it off. And now you owe no credit card debt. You're really happy, right? How much money does this $10,000 make you for the rest of your life? Nothing. Zero. You paid someone else and now they have the ability to go compound your money. But if you took that $10,000 and you started compounding that money, it's going to start growing. Remember, money making money for you. And from the growth of that money, you start paying off your debts. This $10,000 keeps making you money forever. And you eventually end up debt-free. You don't end up debt-free immediately, but you end up debt-free. And you still have $10,000 that continually makes you money forever. See, I have no problem with being debt-free. I have a problem with the order you've been taught to pay off your debt. Compound money, from the growth of money, we leverage it out and we pay off our debt so that it still makes you 3%. Remember, if you had $10,000 or your money starts making you money and you leverage it out at 4% and it's making you 7% on average, and you go pay off your debt, you're still making around 3% on average off your debt. So the order in which you pay off your debt, pay yourself first, compound that money. From the growth of money, we pay off debts, we go on vacations, we buy cars, we go out to eat so that your money continues to compound for you. You guys know what I'm about to say. What do I always say after every video? Always be compounding. Do not let your money die. Your money is your money to keep. Do not let it die. Get it in a system that compounds securely that you can leverage and then go do all your fun stuff with it. Oh, I didn't realize all the questions are right here.
It's okay. Can I transfer my Roth into an MPI?
Can I transfer my Roth into an MPI? Roth IRAs are special in the fact that All the money that you've put into a Roth IRA is called basis. Your amount of money you've put into it has already been taxed, and it is called basis. You are allowed to withdraw that money at any time. There's no penalties. There's no anything. It is your money. You've already paid tax on it. All that is yours. So you could use that money to accelerate an MPI account. We have to build it. We need to make sure that it's all compliant and all the different things with that. But that is your money to use as you see fit. All the growth of your money inside of a Roth IRA is penalized. You cannot touch that till you're 59 and a half. So we don't like touching that money. There are some rare scenarios where you may need that money for whatever situation, and you could pull it out with a 10% penalty. Obviously, that's a decision you'd have to make, and it all depends on why you wanted to use that money, if that 10% penalty was worth it or not. And so that's something, but your basis is something you are allowed to withdraw from with no penalties. And so there are scenarios where we're allowed to use index funds, mutual funds, basis off of various investment platforms that could be used to accelerate a compound account, a good compound account. All the accounts are compound accounts, but we want your money in a good compound account that doesn't lose and then has the match program and the guaranteed security and the growth and all that fun stuff.
Broker Daily on YouTube. Should I allocate 10% of my investment portfolio into Bitcoin or Ethereum? Bitcoin has the greatest ROI year to date.
Okay, so that's a tricky one. Should I invest 10% of my investment into Bitcoin? At the end of the day, there are so many opportunities out there to make money, and they are hard to find. So Bitcoin might be up year to date. As we know from the last 3 years, it could lose all your money. It was at $20,000 back in the end of 2017. Now, I don't know. Last time I checked, it was like 8,000 or 9,000. I don't know what it is now. But it's 50% less than someone who bought it in 2017. So you can't trust that. If you have money and you just want to go for broke, I can't stop you from doing anything. But I can tell you this. If you start a secure compound account, let me go back to this graphic, one of my favorite graphics. If you start a secure compound account, that gold line will produce more money for you securely than anything you've done for your whole life. And so if you want to go for home runs and strikeouts, maybe. But if you just want to be secure and confident, not worry and not look at the stock market every day and just know that you're going to end up wealthy and secure and confident and all the other amazing things that go along with this, then just start a secure compound account. Get 20, 30, 40% of your investment portfolio, if not more, into a secure compound account, even up to 100% of it. And you will not regret that decision, because although it does start off slowly, there's not a lot of growth in the first 5, 6, 7 years inside of a good compound account, because it's money making money, but it's got to get going. It's got to get rolling. It's like building a skyscraper. You've got to go out, then up. You cannot build a skyscraper without building the foundation. You cannot take on weight until you have concrete, rebar, thick, all that other stuff that you need in order to go up. Why the stock market and Bitcoin and real estate doesn't compound is because they try to go up super fast, and they're never, ever, ever built on something that can sustain a down market. They can't sustain weather. They can't sustain a hurricane. They can't sustain rain. But we build the security first. Then we can go up unlimited. And when you start going up with a secure account, it goes up like that. Where Bitcoin could be like this, then like this. You feel really awesome. But ultimately, if you give it enough time, we will dominate them. It won't even be close 20, 30 years from now. So that's my answer to that. If you want a little excitement in your life, I can't stop you, but I've embraced the idea that slow, steady, and secure wins this race, and I want to end up with hundreds of millions of dollars, and secure compound interest will do that for me.
CDG from YouTube. Does the match count towards the MEC limit? On the match example with $10,000 contribution in year 1 and $10,000 contribution plus the $10,000 loan match on year 2, the MEC limit on the policy would have to be at least $20,000, correct?
CDG from where?
YouTube.
From YouTube. You must be in insurance. Yes, the MEC limit. There's a thing called modified endowment contract where we're limited on how much money we're allowed to put into these systems according to how much life insurance you have. So if you want to put a little amount of money, you only need to have a little amount of insurance. If you want to put a lot of money in, you have to have a lot of insurance. So as the match program evolves, so does your MEC limit. It all goes hand in hand. So when you put in more money, your MEC limit increases simultaneously inside the system. So yes, that's a deep conversation. Most people don't know the tax laws inside of the modified endowment contract. It's called a tax code 7702A. If you're real nerdy and you want to know how this system works, I go through this in my book. Remember, the law science of compound interest breaks down all of this. It breaks down to the very finest detail on how you don't mech a policy, how you don't lose your tax advantages, how you put in more money, how the mech limit graduates or matures simultaneously with your extra contributions, etc. But the answer to that question is yes. We need to make sure the policy does not mech because we'd lose our tax advantages. And so MPI is designed internally to mature simultaneously with the match program.
Steve Thompson from Facebook. I may have missed the question, but can I transfer my 401k to MPI?
Steve Thompson from Facebook. Can I transfer my 401k into MPI? Unfortunately, 401ks are trapped. There is not much you can do with a 401k. Let me go to my graphic again. $401ks are trapped right now. You're not allowed to touch it till you're 59.5. There are 4 reasons you can touch a 401k money without a 10% penalty. First one is medical bills. Second one is first-time home purchase, I believe. And third one is education funding. So those are 3 of the 4 that are common. There is one new one that you're allowed to access your 401k for your own personal needs, and that is COVID-19. You can withdraw up to $100,000 from your 401k penalty-free, so you don't have a 10% penalty right here. You still will need to pay taxes on it within 3 years. You don't need to pay it out of the gate, but you need to pay within 3 years. I'm not a tax consultant, so you need to go talk to your CPA. This is what I just read online. I'm giving you what I've read online about this new $100,000 thing. So you can withdraw up to $100,000 if you have been affected at all by COVID-19, lower salaries, someone who's got sick, you've got less money coming in, whatever. What you do with that $100,000 is to promote your best future. However you decide to use that $100,000 is to make sure that you're okay, that you survived Corona, that you've been able to, make sure your financial security is set up as much as possible. That's a decision you can make. But yeah, those are the 4 reasons you can withdraw from a 401k without a penalty. And if you're still employed with your employer, you can't even touch the 59.5 unless you're inside those 4 exemptions. If you have an old 401k, you do have access to it with a 10% penalty to live your best life. And so if you have an old 401k that's not managed by your company, your employer, then you can access a old 401k, 10% penalty. You are taxed on it. You do have access to it, but then you have to decide what you want to use it for your best future.
Earth.io on YouTube. For those of us who just joined, can you explain what secure compound interest is again, and what investment does that entail?
Okay, secure compound interest requires 3 things. And let me see if I have it here. Can't remember if I have a graphic for that. Did I not put a cool graphic on there? Okay, here are the 3 things that are required in order to get a secure compound account. Security, growth, and leverage, meaning acceleration. So in order to have a secure compound interest account, you have to be in something that never loses. If you remember from this graphic right here, it never goes backwards. That gold line is always moving forward. It's always moving forward. It never goes backwards. It's not like the stock market. The stock market that does this, that is not secure compound interest. That's not even compound interest. It is growth and loss, growth and loss. But inside of a secure compound account, your first thing is you got to be moving forward always. You cannot be in a system that loses. You have to be growing, and you have to accelerate it so it gets faster and faster and faster as time goes on. So MPI is the only system, and I'm not overstating that. I want you guys to fact check that. I want you to research it. Nothing would make me happier than you make a dedication right now to learn about compound interest, because if you learn about secure compound interest, you will find yourself to me. Because 6 years ago, it did not exist. I had to build this. I am the architect behind Secure Compound Interest Account. So I build this 10 feature account that has guaranteed security to never lose, growth potential around 7%, which is good. That's equal to like a good indexed fund. But then we accelerate it through the match program to make it go from 7% on average, give or take, up to 15%, give or take. So it is getting faster and faster and faster as time goes on. So MPI is the only secure compound account right now that satisfies the demands of secure compound interest, and that is something that's guaranteed security, has good growth potential, and then can accelerate the rate of return, because as you see from this secure compound account graphic right here, it gets faster and faster and faster and faster as time goes on, and that is the acceleration we need.
Gabriel from YouTube, what is the difference between a CVAT and a GPT in an IUL?
CVAT. What does CVAT actually means? It's an acronym. Cash value accumulator, something. So those are two terminologies inside of the MEC limit, the 77028 tax code. One is designed to focus more on cash value life insurance, the life insurance portion, when you want to dedicate more money and have a lower life insurance cost and put a lot of focus on the cash value or the life insurance inside of it. GPT is focusing on the cash value in it. It allows you to have a little bit lower death benefit, less life insurance, produce better income, produce more compounding results. So I design every single MPI system GPT. Sorry that that's not something, I just design them all the way. I don't put a lot of energy into CVAT because every time I run an illustration on CVAT, it's much worse than GPT. So I just know that GPT focuses a whole lot more on cash value and how we accumulate compound interest than the other one. So every single MPI plan is designed GPT, which focuses on your best compounding effects and putting less focus on the life insurance side.
Diane from YouTube, can we borrow from an inherited IRA?
Can you borrow from an inherited IRA from Diane? How you doing, Diane? I haven't talked to you for a while. Hope everything's going good for you. But an inherited IRA, borrowing from an IRA, I don't know much about that. So I can't fully answer that. You know, I'm not scared to answer when I don't fully understand something. Wouldn't you just withdraw it? I don't know if an inherited IRA has the leverage feature to borrow against it. I know 401ks, you can borrow against them and then you're required to pay them back. I don't know if those same rules apply inside of an IRA. So if you had an inherited IRA, you can withdraw it, pay the income tax that you're owed. I mean, you have to pay the income tax on an IRA, and then ultimately you'd have that money then to accelerate maybe another investment platform, a retirement plan, use it for whatever you wanted. So that is my best thing, is talk to your accountant about that, because I don't exactly know all the rules on an inherited IRA.
JC from YouTube, what is your philosophy on emergency funds? Should it be 3 months or 6 months or more?
So JC from YouTube, what is my philosophy on emergency fund? So an emergency fund is important, but it's not as important as they play it out to be. I know this is going to hurt some people's ears, but an emergency fund is like, how often do you use an emergency fund? Yeah, there are emergencies sometimes. So I don't put a lot of attention into an emergency fund because MPI is liquid, has lots of liquidity after the first year. So we do have a 1-year window where we don't have a lot of liquidity. So imagine that you put in $5,000 into MPI in the first year. There wouldn't be much liquidity, so it could not be used as your emergency fund. One of the amazing things about MPI is that it is no age distribution. I'm going to clean this up. No age distribution. And so what ends up happening is that this becomes your emergency fund. You don't want money sitting inside of a bank account because it loses inflation up to 3% per year. It loses its value. And so if you put money inside MPI in the first year, there's not a lot of liquidity. But if you put money in the second year, most of this is liquid. And then the third year and the fourth year, and it's growing and it's compounding, it's making money. Within 10 years, you have $100,000 in this account. You have $500,000 in the account in 20 years. You have $1 million in this account in 30 years. It becomes your emergency account. So yes, you should have a little bit of money set aside in the first year, but after that first year, MPI becomes your emergency account because it's liquid without penalty.
Wilfred from YouTube. How do you use MPI to pay off your debt, including your student loan and mortgage?
Okay, so MPI, Wilfred from YouTube, how do you use MPI to pay off your debt, including student loans and mortgages? So I'm going to go to, I think I have that on here. Here it is, 529 plan. Who's seen my video? 190,000 people have seen my video on TikTok about why I think a 529 college kids plan is the worst compound account ever designed in the history of mankind. And I'm going to explain to you why. Right now, your mind's going to be opened a little bit on how the power of compounding really works. In a 529 plan, you go save money for your child. And let's just say you save $250 a month for 18 years. At the end of 18 years, you'll have roughly $136,000 inside this account if you were to go put in like an S&P 500 index fund. Then your financial advisor, who knows nothing about compound interest, I hate to say that, I know those are fine words where I come from, but has no idea how compound interest works, tell you, congratulations, you can spend that money, or your child can spend that money, end up college debt-free. They can get college educated and debt-free. And you end up killing $137,000 that was going to make you millions and millions and millions of dollars to your future or your kid's future. You killed a compound account. There is nothing worse in the whole world, a financial world, that you could do than to kill compound interest. Because remember, it gets faster and faster, producing more and more money for you. But if you design that same plan, put $250 away for a child, and let that grow, and let's just hypothetically say it's also $137,000, even though we'll be a little bit more than that, but it's $137,000. Rather than using that $137,000 for college debt, we're going to take student loans. I know that's opposite, but I'm going to tell you how math works. Because you don't have to pay interest on that student loans as long as you're in college. So let's just say you go to college 5, 6, 7, 8 years. You want to go be a doctor, dentist, whatever. You're not going to pay any interest on that debt. And let's hypothetically say you get $137,000 in debt, equal to this right here. Remember, you use your 529 for $137,000. You now have $137,000 in debt. When you graduate at around 24 years old, your account will be roughly $266,000. You compounded one full time while you were going to college. You allowed your money to continue to compound even though you took on $137,000 in debt. At that moment in time, you could borrow out, take a loan, take the match program, $137,000 out and pay off your whole debt. You never paid an ounce of interest. And you still have $130,000 compounding for you because you never let your money die. You continued to compound your money. An even better way of doing it is then your mortgage or your loan off your student debt's only going to be around 5%. That's the national average is 5.8%. You can use the leverage feature to pay $804 per month. Basically, you take out $804 as a match program, but instead of putting it back in, you're paying your loan, your student loan for 30 years. For 30 years, you're going to pay $804. No money out of your pocket. That money was compounding. It continues to compound, and you use the growth of the money to pay off your debt. By the time your child got to 54 years old, there could be up to $3.3 million of compound interest in this account and could retire off of $363,000 a year. That's the power of compound interest. Never let your money die. So if you start a compound account, get as much money into it as humanly possible, as fast as possible. It will start generating you money. And within 3 to 5 years, you can then start using growth of your money to start paying your debt so you can put more money back into your system. And so yes, in the first 3 to 5 years, I recommend you pay the lowest amount of debt as possible, pay your minimums, and get as much money compounding as fast as possible. Let that money start compounding, and then it helps accelerate the payoff. You can actually pay off your debt faster. You can pay off your mortgage faster. You can pay off all the things faster by getting money compounding. Okay. One more. Last question. Which question is it?
Oh, they're all done, actually.
Okay, then I have one more. I'm going to go over one more here that is infinite banking concept. A lot of you come on here and say, oh, this is just IBC, infinite banking, bank on yourself. You've probably heard of this concept called bank on yourself, infinite banking. I love these guys. They're so animated and they love to act like this bank account's like going to do those amazing things. But I'm going to explain to you the difference between MPI and infinite banking concept. Infinite banking concept basically tells you if you had $50,000, this is a hypothetical number, that you can go put it in this whole life plan. And this whole life plan is going to spit off a dividend around 5%. But the money's also liquid. So you can then take this $50,000, go get a 5% loan, so your money is no longer making money for you, but then you can go pay off your credit card debt or your home debt or buy a car, and then the interest you're saving, I'm going to call it interest saved, you then put back in the account to make your 5% interest. It makes no sense at all. Like, I'm sorry, infinite bankers, bank on yourself. I'm a mathematician. I've run this 100 different ways. I've had you guys show me your different things, and it does not make money. It feels really good because I get to pay off my debt. You know, the name of bank on yourself sounds so cool. I wish I would have come up with that. You know, mine is the MPI match program. That's really cool too. But bank on yourself, infinite banking, all these cool words, they just don't make any money because it null and voids out the compounding effects in it. If you then let this money compound over the next 50 years, $50,000 will turn into around $800,000. So they go on and say, hey, 50 grand turns into 800 grand. That's really, really awesome. And there's nothing wrong with that. That's actually pretty cool, right? Inside of MPI, that same $50,000, but compounded, accelerating your compound interest, 7 to 8 to 9 to 10 to 11 to 12 to 13 to 14 to 15 on average. That same $50,000, all internally done. You didn't have to take a loan and then go pay off a car debt and then go take this and take the different interest and put it back in the account and do that over and over and over. All ours is internally handled for you. It is managed for you, but just slow, steady, and secure banking on compound interest. Bank on compound interest, that's what I should call it. Not bank on yourself, bank on compound interest. Up to $12.8 million in the same time frame. 16 times better returns, better cash value, better retirement income than infinite banking, bank on yourself. This is just math. I will go head to head. I will do side by side. I will do live presentations with any financial advisor, any infinite banker, anyone who wants to take their portfolio versus MPI. And we're going to find out that it was never about the rate of compounding. It was never about the interest you're paying. It was never about your debt. It was always about the rate of compounding, not the rate of return. Always be compounding, my friends. The moment you understand compound interest, it will change your life forever. Do not delay. Go get my book, The Lost Science of Compound Interest. If you are struggling with money right now and you can't afford to purchase this book, please reach out to me. Send a message at info@suncorfinancial.com and we will get you the free audiobook or the PDF book. I want this information to be provided to everyone. So I will not charge you. I get it. Obviously, I wrote a book. I put a lot of time into it, so we sell it, right? I make like $2 on a book every time I sell one. And hopefully in 50 years, I break even on the amount of money I have in the book. But if you're struggling with money, I want you to have this education. So please reach out to me. We'll get you the Lost Science of Compound Interest, and I'll make that happen. And always be compounding, my friends. Oh, there's one more?
We do. We have someone that wants to go.
Uno más. Okay, last one, and then I got to go. My wife wants to go out to eat. We're going to go live, as you said?
Yep, they're just connecting.
Okay. Okay, wait 1 second. Okay, I'm on live with someone right now. He's got a question. What's up, brother?
Yo, so if you were to cash out me $10, can I cash out you and slip that and give you 15?
I'm sorry, say that again?
If you give me $10 via cash out, can I give you back 15 tomorrow? I need $10 really bad.
That's not really a live thing, brother. That's a personal conversation. So I get it. You need $10 right now. Cash apps, unfortunately, have a lot of fraud in them. I don't know you, so we'd have to talk a little bit and make sure I trust you. We'll talk after this, but thanks for reaching out, brother. Hey, I'll talk to you after this. Well, I want to know what your story is. So thank you guys again. Is that good?
Yeah.
Questions keep coming in.
One more.
Last one, so my wife doesn't kill me. I will be home, honey.
Wilford said, how do you funnel it now do you have to, after you pay off already existing loans? If you already have existing debt, can you use this process to pay off the debt?
Yes, we can use this process. So Wilfred from YouTube, Instagram, wherever. So what I believe in is pay your minimums to your debt, because you have to pay your minimums. There's no way around that. Pay your minimums. Get your money compounding so that the money makes money, and that's how we're going to accelerate your debt payoff. So one amazing thing about compounding is the moment you understand compounding, all the frustrations and anxiety and fear and pain and what's that word, shame that you've been told for having debt, let it go. It's stupid. Debt and shame off of debt is a stupid feeling. Let that thing go. Today's your day to change. Today is start thinking abundance. Today is to start compounding. And from the growth of money, we'll be able to pay off your debt. But you got to get money making money for you. So it's basically hiring employees to make more money and more money and more money. So if you can start a compound account and just pay your minimums for the next 3 to 5 years, I get it. It hurts. You're seeing all that interest leave. But once that happens, your compound account is going to start producing liquidity, it's going to start producing interest, it's going to start producing additional interest for you, and that is how we're going to pay off your debt, and you will still have money compounding for you. And that's the secret, is always be compounding, never let your money die. And thank you guys. Awesome. We're going to do this next week also. Always be compounding, be safe, get your money compounding, and you will never regret that decision. So have a great day. Talk to you soon.